Oh my God. Captain, put on the world music. The day is saved.
Welcome to the Sunday Platinum Channel Swing Trading Review. This is going to be a pretty cool video because we're going to get into U.S. job payroll numbers and what I'm really concerned about, along with Mark talking about Apple and its earnings and its charts, along with many other different things we talked about on the Platinum Swing Trading call on Friday with our tribe members. Thank you for subscribing. Hit the like button and help support this video and the Best of US channel. Let's get going. So Apple reported earnings and they were pretty strong. They set some records on some of the things they're doing. But the thing about Apple and their guidance for this quarter and the holiday season was, well, no growth is basically what they said. And if you think about Apple, you got to ask yourself, at what point do I just not need a new iPhone? Or at what point does spending $2,000 to $3,000 on an iMac Pro with substantial storage and speed, at what point does it, well, I can't afford it, especially with the fact that everything has gone up in price. And now, I mean, where does Apple go? Well, and that's what Mark jumps into the charts and breaks down the charts as he sees it. And let's check that out.
With Apple, the market went up and up and up. We saw last week, and we're still up 5 days in a row, which is amazing. But that's the way the markets are. The markets are not the economy. So when we look at Apple, yesterday, interesting chart. For the last couple of weeks, we've been, on this downtrend. And then, this week came along and we came up. This was earnings. You can see we had a gap up yesterday before earnings, this whole gap here. And then I said, earnings, I said in one of my posts, if earnings aren't what they used to be or what they should be, you're going to see that gap filled. And so you see that gap did fill. And then it came back up and it hit the 50-day simple moving average. So we're seeing a little resistance. We've seen resistance before at the 50. Yesterday, I thought it was interesting because it went right up to the intermediate resistance level, and that's where it stopped. And today we're at the 50. We'll see where it ends up. You can see the RSI is popping just a little, still above 50, but a little bit of a momentum loss, from yesterday. But the MACD and the stochastic still look good, but we still have the 50 and its intermediate level above us. So that's Apple. Any comments, anything, Trent?
I think when you span out to about a weekly chart, you can see this thing's on a downward trend from a intermediate standpoint, so longer than 21 days. It in my opinion, it's headed south. But that's just my opinion. And I think the more and more we see some economic strain on the consumer, this is going to get harder for them to sell these very high-end products, and it's going to start showing. So that's my take on it.
I see a lot of homeless. I see a lot of homeless people with Apple phones.
That's a government give.
Yeah.
Your tax dollars are paying for that.
So the market's been taking a beat in the last 3 months, though, right? So when we look at these stocks, we have to be cognizant of what the overall market has done.
Well, yeah, here's 6 months. You can see, we're in a downward slope from the high back in the, July area. And markets go up and markets go down. See, up, down, up. That's why we swing trade. Here we get above, swing down below the 9, swing down, kind of play the line here, get back in here, swing out, come back up, get out before earnings. Of course, that works or it doesn't work, depending on what your risk management is. And that's why we do it. You can see the swings in the market. But there are trends, Paul, and you've got that right. You have to always back out and kind of see which way we're headed in our trends too.
what I find interesting is the
I've done that.
the height of each swing up, if that makes sense. So the distance it travels. So, if you go back to, what is that? Right, right in that area, your first dip down and the swing up was pretty sizable. And then the swing down and then the swing up is narrowed. And then the final dip down and then the swing up is narrowed as well, from just visually looking at it. So
Well,
those
that's where
higher lows or lower highs and
lower highs and
lower
lows.
lows. Yeah.
Yeah.
So
Here we didn't. Here, yeah, we're still, in that trend. We're right up on the line right now.
yeah.
I don't know how good I drew it at this big pace. Well, fairly good, but we're coming right up to that. We'll see, because it's got a lot of resistance, with the 50 and this intermediate. That's why they're resistance, and we'll see what happens. And the day's not over yet,
No.
But yeah, a lot of times you'll see markets do this, pop up, they'll hit a resistance, and they'll either come back down and check off that and then go up again, or they come down and they just keep stinking. So that's where you got to be cognizant, not only the charts, but what's happening, what we call market conditions, wars in different parts of the country, when Powell speaks, when Janet Yellen speaks, when earnings come out and such like that.
Yeah. The second thing that Mark got into was the Federal Reserve's decision not to raise rates. Now, that was pretty much expected, but it's sort of the language within the statement that's interesting. I think more importantly, everybody is talking about at what point does the Fed lower interest rates? And Mark points out in this next segment about when they typically do. Well, let's let Mark explain it. So the third thing that Mark points out is the U.S. Treasuries need to borrow more money to fund the government. Now, it's less than last quarter, but still, they're expecting more revenue to come in, and maybe that's because of late filers who had to file on October 15th of this year. Maybe they're expecting tax money to come in from that. But it's a question of how much longer are they going to continue to need more money? I mean, it's an example of our government is overextended and is spending too much money, so they're having to borrow more money, which means then when they offer to borrow more money, they have to issue U.S. Treasuries at a higher rate to make them more tantalizing for the consumer, for the institutions to borrow that money or to lend that money through buying U.S. Treasuries. And this is where you're starting to see the movement in the U.S. 10-year Treasury, along with the 2 and every other one. And the yields are continuing to go up. But now this week, the U.S. 10-year actually came down to right around 4.6%, which has created this environment of, oh, it's over, everything's better, and the whole bit. But what people aren't really thinking about is the fact that China is having a challenge right now, and they're needing money. They sold off a couple weeks ago about $40 billion in U.S. Treasuries to fund their banking system, with another $100 billion that they injected to keep their banking system afloat. So should we expect the U.S. 10-year Treasury yield to fall and the values to go higher in the coming months? Or are we more likely to see the U.S. 10-year Treasury and other long-term Treasuries go up in yield towards 5% on the 10-year, or even break that, because the other parts of the world are needing money, and since their assets are primarily held in U.S. Treasuries because they transact everything in U.S. dollars, well, are they going to sell those U.S. Treasuries and raise money so they can fund their economies? Well, chances are, yeah.
Looking at history, and you guys can all tone in, when the Fed starts pausing and then reversing, rates. History shows that, initially the stock market will go up, but the reason that they reverse rates is because something's wrong, either too much unemployment or prices are too high, whatever's happening, and then you start seeing the markets go down. So we'll see if history repeats itself in this case or not. And then the last thing, my 2 pages of notes. These notes get longer and longer. U.S. Treasury expects to borrow $776 billion in the fourth quarter, and that's down from 852 of the prior quarter. And that's on the expectations they're going to have higher revenue receipts in the U.S. Treasury. So that's going to require them to have less borrowing in the Treasury bill area. And we'll see if that happens, because what I'm seeing is Treasury receipts have been sliding, receipts to the Treasury have been sliding here, and we'll see if that turns around. They're thinking some of the forbearance that they've given out for some disaster relief is going to start coming in, and we'll see how that works. The Treasury will also sell 112 billion in long duration notes and bonds. That's over a year up to 30 years versus 114 billion. So they're going to sell less of those higher rate bonds, discouraging the Treasury from issuing longer term debt in favor of short term bills. So they're going to keep using short term bills as opposed to long term. And the thinking on that, from my perspective, is they don't want to have long term debt at 5.5% for 30 years. They're betting on shorter term. We'll do month, 3 months, 6 months at 5.4%, hoping that the rates will come down. Then we can work on longer term debt. The issue that we still have is that China and Japan and others are not buying our treasuries, even the short term treasuries. It's either the banks, the hedge funds, us, ETFs, whatever, that are buying these. And we're going to demand higher rates now, because if the market keeps going up, why would I keep my money in treasuries when I'm going over and I look at the charts, and the charts say, wow, we're going to go up for a while. I can make 8%, in the next week or so. Why am I going to do 5.5% for a month in treasuries or 2 months in treasuries? So money always goes where the value is. So I see markets going up as a threat to what the Treasury is trying to do. And that what the Treasury is trying to do is keep the money flowing in to support the U.S. government's deficits and debts and spending. And we always talk about raising more money and raising more taxes, it seems, but we never talk about cutting anywhere or becoming more efficient like you and I have to do in our own households or our own businesses.
As always, it's important to look at broad markets before you start analyzing the small stuff or the individual stocks. And so Mark got into looking at what the S&P 500 has done for the week, what the Dow Jones, the NASDAQ, and then he got into something that I think a lot of people don't know a lot about, and that is gaps. Let's let Mark talk about the indexes and what they did, but then Paul's question about gaps.
Look at the gaps. Okay, so here's yesterday. Today we gapped up on the S&P. We're now above the 50. Yesterday we crossed over. We gapped up above the 200. So now we're basically in bull market territory. Got nice shooting up MACDs, stochastics, RSIs. Oop. Someone say something?
No,
so again, this was the 4,200 level, which was, when we dropped below 42, we thought, oh my gosh, and then we came back up. And so now we're back up, above the 50, and we're seeing the Bollinger Band move up. Let's go look at the Dow Jones. Dow Jones crossed back, and Dow Jones was under the 200 for quite a while. Yesterday we popped up, we stopped right between the 200 and the 50. Today we gapped up, another gap, a lot of gaps to fill here. So remember that as we watch this go up, gaps usually fill, not always, but they usually fill. We got the 9 and the 20, the shorter term moving averages starting to screen back up towards price action. Again, you see again the MACD, stochastic, and the RSI moving up. So basically, if you wanted to swing trade into the indices, they're giving you an opportunity to do that. Again, I would look at the gaps coming down, and again the weekend coming up, and then the NASDAQ. NASDAQ again, now it closed above 50. We got a Bollinger Band moving up, spreading out, which shows we have more volatility in price. You can see we came down just like everyone else. In the last 5 days, we've screamed up a lot of gaps again here in the NASDAQ. And we're showing, again, good MACD, good stochastics, and awesome RSI on these indices. But again, a lot of gaps. It's just based on your risk tolerance and what you want to do.
The gaps you're referring to the candlestick itself. When you say gap, it's between the
Yeah,
open
right.
and close. That open.
I'll show you here. Oops. The gap is between, like here's Apple. See where we closed right here? We closed at 173.97. And then the next day, we opened way above that close. There's nothing here. That's your gap. So what happened today is we came back, we filled the gap, basically, came back down, which tends to happen. And then we went right back up. And on Apple, we're hitting on the 50 again. Again, you can see we've had some history of the 50 maintaining a good resistance level. But there's your gap right there.
So then next, Mark breaks down his Berkshire Hathaway trade. And Paul asks, well, where do you take the profits? And how do you think about that? So let's let Mark explain that in this next segment.
On Berkshire, I think that was 341 or 340.50 where we got in. And now we're at 354, well, about 354. So 13, 14 bucks on Berkshire. So I'm happy with that trade right there.
How did you, what's your target at now? I mean, I guess what I'm trying to say is you're probably watching it pretty closely then to set your limits, change your limits. Sorry.
Well, right now, I want to be above my cost basis right here. And the nice thing about it is finally the 9, which, is your ultimate short end resistance level on a swing trade, is now above my cost basis. So when I look at this, you got to make a decision on what you want to do. Do you want to use the 20 and put in, this is where I want my sell limit at the 20? Or do you want to go back and say, look over here. We had a nice trend right across here. You want to come over and put it somewhere in this area where we've had some sideways patterns right at this point. You want to do that, make some more money on that, take a little off the table. What do you want to do? It's up to you, really, Paul, what you want to do. Once you're ahead of the game, the only thing I want you to do is not lose money. So always set your limits above so you don't lose money. You are now playing with house money. This is the best situation you could ever be in a swing trade. When you get above your cost basis, you've got to get away from your psychology of saying this is going up forever. Okay, it won't. We'll go back a year. It had a nice run. This has been a nice run. But at some point, we'll see what happens. Here we crossed over the 50, we went up, went back down, hit the 50. The 50 is pretty a nice line of resistance and support, basically, for Berkshire. We'll see if it stays above it. But right now, I'm up 13 bucks. How much do you want to lose? Do you want to lose 10? Do you want to lose 6? Do you want to lose 2? How much do you want to make is the other, the positive side of that. So it's really up to the individual and what you want to do. I try not to tell people what to do. You have your own risk tolerances. What would you do here? What would you do here? If you were in this position, this was your cost basis, what would you do?
The question is, you've made money in a swing trade. You've made money like it's in your pocket. What would you do? Mark asked the question, what would you do if you had made, 2, 3, 4, 5% plus on a trade? Would you get greedy? Would you have FOMO? Would you just ride this out? Or would you just say, you know what, according to my process, my price target, in this case, it was the Berkshire's 50-day moving average. Would you take it? I would. I think that's the important thing about the Platinum Channel Swing Trading Program. And that is it teaches you discipline. It teaches you how to look at markets without emotional baggage. And we all are guilty of emotional baggage when it comes to buying and selling a position. Most importantly, selling a position. It's easy to buy something, but it's really, really hard to sell it. And when you have a proven process that is based on statistics, stats, moving averages, and you put it all together and you follow it, you make money. Whereas, well, it could go higher. I don't want to miss out on that. That is the recipe for losing your butt. So, in closing, we have a lot going on. Last week was a rally week, yet nothing economically has gotten better. I mean, think about it. The U.S. non-farms payroll, they've been revising down. August, they revised down 62,000 jobs from 227 to 165. So the numbers that came out at this week on Friday with 150,000 jobs and 3.9% unemployment most likely will be revised down. So economically, we are not getting better. In September, they revised down 39,000 jobs from 336,000 to 297. So can you believe some of the data that is coming out? Or can you walk around and look at your pocketbook and ask the question, am I getting wealthier or am I spending more money and getting less wealthy? Learn to become wealthy. Join the Platinum channel. Hit the subscribe button below. Thank you again for watching. Hit the like button and go check out bus13.ai. bus13.ai. That's our website. Check it out. bestofusinvestors.com. Peace. Have a great week.